Hi, Mike. Nice to see you, too.
So, yeah, I guess the real simple story of how stocks have held up as well as they have for a while now is inflation coming down faster than the economy has weakened. How did today's data of last Friday's jobs numbers, how do you feel that all works together in terms of setting expectations for the markets and the economy this year?
Well, obviously, it was a little bit hotter than expected. And I think we're at that point in the disinflation cycle where it is unlikely to be linear. I think there are forces, including things like geopolitics and what's going on in the Mideast, that could disrupt a nice clean path for inflation getting back to the Fed's target. But as you point out, there is still a disconnect between essentially what the Fed's been saying, what's embedded in the dots plots and their summary of economic projections, and what the market has priced in. I was a little bit surprised that you didn't really see much of a needle move in terms of expectations for the March FOMC meeting, which still is about 2/3 cut, 1/3 stay the same in terms of probabilities. I think that may still be a little bit of a stretch in terms of the market's expectations.
Yeah, it's interesting. We obviously a couple of months till that March meeting. We do have the PCE report, which is where the Fed's actual inflation target is reflected, and that comes in a couple of weeks. Folks looking at the CPI number saying maybe it translates to a little bit of a softer PCI number. But all that being said, how much do you think the priced expectations in the Fed funds futures market really reflects what most investors want to see and expect to see, as opposed to it just being, somewhere along the spectrum of possibilities? How much does the stock market rely on deep Fed rate cuts this year, perhaps?
I guess we're going to have to see, to the extent the market's expectations are wrong and the Fed has to more aggressively push back or do what they don't tend to do, which is actually surprise, let's say, at the March meeting by going against expectations, assuming those expectations don't adjust between now and then. I think it would be probably a pretty swift adjustment. I think not only has the market done well and stabilized here because of an expectation of yields moving down, as well as the Fed starting to cut interest rates, but that helps to explain the move down the cap spectrum, and not every day, but some of the lift that we've seen in small caps, the Russell 2000 equal weight relative to cap weight. But anytime there's a little bit of uncertainty, what you do see is you see a little bit of that reversion to the mean kind of trade. Today is a perfect example of that, where earlier this afternoon, only energy was in the green, but then you saw technology leapfrog that. So I think that there is still some money that automatically goes back to that corner when there's any uncertainty with regard to what has been the biggest driver, which is the combination of yields and Fed policy.
Yeah, no doubt about it. It's sort of the defensive trade. Feels like it's the easy way to sort of hide a little bit. What do you make of the overall action so far this year? I mean, obviously, in trying to figure out how much we're reacting to the data in the last week or two, we're also trying to digest a massive rally from the final 2 months of last year. We obviously, by everybody's acknowledgement, got a little bit stretched. You had sentiment needing to come off the boil. Where does that leave us?
So I think sentiment is mixed right now. You have seen some of the attitudinal surveys of sentiment. The bullishness, which had gotten pretty rampant, had eased pretty quickly, and that was alongside some of the weakness that we saw up the cap spectrum. If you look over the last 4 to 6 weeks, you've seen that better performance by equal weight down the cap spectrum. The one thing I would express is that I think investors should be really cautious if they're looking for opportunities outside of not just the Magnificent Seven, but up the cap spectrum into sort of the growth trio of tech communication services and consumer discretionary. I don't think you want to sacrifice quality, particularly if you're using as a base for ideas the Russell 2000, because it's still got a hefty share of zombie companies, not profitable companies. Just as an FYI to viewers that aren't aware of this, the S&P 600 as another small cap index, although not used as a benchmark as much, has a profitability filter. So you start with a higher quality component of stocks maybe from which to choose. I don't think you want to sacrifice quality. And from a factor perspective, we are emphasizing almost what used to be called sort of a GARP approach. You want to look for those growth factors, but without sacrificing valuation factors.